This is No Lazy Money with Nick and Jim from Peak Wealth Management. Real people, real money, real talk. And your host, Ryan Ermanni.
760 WJR. This is No Lazy Money with Nick Hopwood, the president and founder of Peak Wealth Management in Plymouth, and Jim Pilat, the vice president. You can find them directly online at peakwm.com. This show is where we do not sugarcoat it. We don't let your money sit around and do nothing. These are real people. It's real money. We are delivering real talk. Zero laziness allowed. No Lazy Money. Nick and Jim, they take a holistic, comprehensive planning approach. Over the next hour, we are going to share some real-world stories and results, as well as some personal strategies. We're going to talk about a complimentary beneficiary IRA analysis. We'll let you know who can get in on that. We'll talk about the Iran oil spike as well. Over the next 60 minutes, we hope you stay tuned. This is 760 WJR. No Lazy Money. Wealth Management, Jim Pilat, Nick Hopwood. Gentlemen, it is great to be with you again. Nick, how you doing, my friend?
Good evening, Ryan. Thank you for having us back. It's great.
We've got a lot to talk about. We'll get right into it, and we have to start with the conflict in Iran. Oil spiking, gas prices up, volatility in the market. What do people make of it, Nick?
I thought we were talking about spring break to kind of ease in a little bit. But I guess if we must talk about Iran and the oil spike, we can do that. You know, what we've seen is a broad sell-off in the market. Oil spiked up over $100. It's settled in the 90s. But there's a lot of uncertainty with what's happening in Iran and when it will end. And our base case is that, you know, we listen to our leaders and we understand that it should be soon, that it will be over. So our base case is that we have a correction at the worst, not a prolonged bear market. But, you know, we expect these corrections every year. And maybe this will be it for 2026.
Yeah, I think that's one of the bigger takeaways from what we're seeing is volatility is not abnormal, right? Every time there's a news story that pops up, people think this time's different. I have to do something. I have to panic. But in reality, we see volatility year in and year out.
And we actually just saw it, gentlemen, last April during the tariff discussion. The market fell so drastically, so quickly, and people were running around panicking, making jokes about your 401k becoming your 201k. And then ultimately, by the end of the year, your 401k was not only didn't recouped everything and then added 20% to it.
It absolutely did. In fact, last year we had a 21% drop in March and April. So this has been more of an orderly sell-off that we've seen so far in 26. But in 25, it was acute, it was sharp, it was very painful, very fast. And the rebound came just as fast as well. But Jim, I think, you know, that 21% drawdown finished the year with a 40% rebound.
Yeah, and that's what we see more times than not. You know, when we look at history and we look at average drawdowns within the year, it's very common, you know, that we see drawdowns, you know, in that 10, 15% range pretty frequently, more frequently than people think.
I would imagine what age you are maybe makes it easier or harder for some people to stomach as well. I mean, if you're within a year or two of retirement and the market is fluctuating like this, you're probably panicking a little bit more than the guy that's got 20 years left, because the market will always correct itself, or at least we hope that's what history dictates anyway.
You're absolutely right, Ryan. If you're 46 and you have 20 years to work, you think of this as an opportunity. And maybe when the market was down 5%, we've seen like a 7% sell-off. You know, maybe you could put some money to work if you're thinking opportunistically. But if you're in that retirement red zone leading up to retirement, you definitely think about it differently. If you're in retirement, definitely thinking about it differently. And that's why we preach to our retirees and our retirement red zone people that we have to have some cash on hand, not because we want to be opportunistic and buy, but we're going to need that money to live on. So you can't be selling because you need the money at the lows. You want to have it set aside in advance.
What are some of the calls that you're taking from your clients now? What is their reaction to this conflict financially as it relates to the markets and everything like that? Is there panic? What is your main message to clients?
Yeah, I think anytime we see a news headline that people, are shocked by, it leads to some calls where people are concerned. They wonder if we need to make changes. Do we need to change our portfolio? Do we need to get in different sectors? Do we need to do all these things? And typically our response to them, again, it depends,
Sure,
it
it
depends on
varies
the
between,
stage, right?
exactly.
But, typically we want to stay the course. Our goal at Peak is to always get the portfolio right the first time so that you can weather whatever volatility we see, that we're not taking too much risk so that when the market pulls back, you shoot yourself in the foot and sell at the worst time.
That's a great point, too, Jim. And Nick, expound upon that. Every client that you guys deal with, there's a game plan individually for that specific person, for that specific family, that need, that sort of risk level, and that probably is baked into what you already have with any particular client.
I think that's well said. We're planners at heart first. Our team of CFPs with Jim and Preston, we build the plan. We make sure that we have a 99%, 100% probability of success to weather these types of storms. We set aside the cash that we need if we're in retirement. And then we remind people, hey, we have 2 years of cash. We can weather this storm for another 24 months before we would need to sell anything. And most likely the market rebounds over the 24 months. That's what history tells us. And finally, it's not going to break the plan, right? We can update the plan with today's new numbers. Your account's down. If we're using these numbers today to project, how does it look? And it generally still looks pretty good.
You are listening to No Lazy Money here on 760 WJR. Our good friends Nick Hopwood and Jim Pilat of Peak Wealth Management in Plymouth. And if you email Nick, you're going to get a complimentary beneficiary IRA analysis. That is going to be given to the first 5 listeners who contact Nick Hopwood at nick@peakwm.com, asking you to put WJR in the subject line and indicate that you have questions for Nick and Jim about your account. So the first 5 listeners who contact nick@peakwm.com, you're going to get that complimentary beneficiary IRA analysis. Tell me more about that, Nick.
Well, the next segment, 2 segments from now, actually, we're going to do a deep dive into the beneficiary IRA situation. For a lot of people, it's tax bombs that they're going to be faced with because the rules have changed. So we'll tease that segment. But I have another stat for you with the corrections.
Okay.
This is very interesting because Jim said almost every year we have a 10% correction. Well, it averages about every 1.5 years. But sometimes it's worse than 10%. In fact, since 1980, the average correction is 14% per year, okay? Doesn't mean that we're going to see that every year, but those are the numbers, and it's dragged down by years like 2002, 2008, right? So it's an average, not a median. But we expect this every single year. And again, if we look forward, if we buy when the market's down 10%, if that's your threshold for a buy trigger, if you look forward 12 months, on average, you're up double digits looking forward. So that's the part that people tend to forget about.
That's incredible. Jim, do you want to expound upon that?
Yeah, just some more statistics that I think are interesting. We talked about the frequency of these pullbacks. A 5% pullback happens in 95% of the years since 1928. So really long history, but we see 5% pullback 95% of the time, pretty much once every year. 10% pullbacks, 64% of the years that we go through, every 1.5 years, like Nick just mentioned. And even some of the deeper pullbacks, like a 15% intra-year decline happens 40% of the time, so every 2.5 years. And then 20% is, that bear market number that people tend to attach to. 27% of the years we go through, we'll see at least a 20% pullback, so once every 4 years. So I think it's just reminding people that when we see these, it doesn't mean it's the time to panic. It doesn't mean we got to make changes, we got to scramble to do something different. It's natural. It happens frequently. We've seen it over history, and we need to be prepared. Like Nick was saying, have a financial plan in place that allows you to weather that storm, but know that the end will come. History shows us the end will come, and we'll be better off by staying the course.
The message, essentially, take a deep breath. And that's what we're going to do right now. We're going to take a break. We'll move aside. We'll come right back. When we get back, we're going to talk about Jim's pre-retirement checklist and things you should do right now. We'll do that. This is No Lazy Money. Nick Hopwood, Jim Pilat of Peak Wealth Management in Plymouth. This is 760 WJR.
You're listening to No Lazy Money with Nick and Jim from Peak Wealth Management. Real people, real money, real talk. Once again, here's your host, Ryan Ermanni.
760 WJR. This is No Lazy Money. Nick Hopwood and Jim Pilat of Peak Wealth Management in Plymouth. I'm Ryan Ermanni. Glad to have you along with us. We are continuing to talk with our friends about the markets, financial analysis, everything going on in the world that is dictating what's happening. And we want you to be prepared. And one of the ways you can do that is with a pre-retirement checklist. Maybe some of you now that are listening, driving along in your car, or however you are listening to this show right now, you're thinking about retirement. How do I get there? What do I need to be doing? Can I retire? So, Jim, these are your priorities. This is your checklist, you and the team at Peak Wealth. So run me through some of the things that you want to share with us.
Yeah, thanks, Ryan. This is just something that came about. Clients from time to time want to know if they're ready. What kind of things are they thinking about, not thinking about? So we just started to put together a list, and on the show before, we've talked about 4 questions you need to ask yourself. Do I have enough money? That's where we help. Have I accomplished all that I want with my career? How are you going to fill those 40 hours? And then is your spouse on board? So once we get beyond those questions, the first thing we want to do, so often when people think retirement, it's like, I want to retire next year. What do I have to do? But really, the red zone starts at least 5 years in advance. We really need to make sure that you're on track, you have time to adjust, and you have time to course correct if it's not looking like the retirement that we want.
Is your spouse on board? Question 4. I would assume if question 1 is answered, do I have enough money? Maybe that would help with number 4.
Well, oftentimes number 4, if your spouse is already at home, maybe she doesn't want you at home for another 40 hours a week, right?
That's where question 3 comes in about us.
What am I going to do? Yeah.
What am I going to do? But you talk about that retirement red zone too, and in 5 years in, these are when you're starting to think about this stuff. How is that question answered? Do I have enough money? That is, I think, the number one question for so many people, and that's why it's one on your list.
Yeah, so often everybody, that gets talked about, what's my number? What do I have to get to? Where do I need to retire? That's probably one of the questions we get more than anything. But the answer is, I have no idea, right? And that sounds funny because I'm supposed to have all the answers. But the very first thing you need to know is how much money do you need to live on in retirement? You may not, live on $5,000 a month, so Security takes care of $4,500 of it. You need very little saved. But maybe you want to live on, $10,000 a month, $120,000 a year. And you only have $1 million saved. Is that enough? I don't know.
Probably not.
That's probably not going to look so good. Yeah.
And so maybe the first question you ask yourself is how much you want to spend.
Yep.
Yes.
What's that spending goal exactly?
And interestingly, most people don't know, which is a challenge. It's challenging for us because, if you're putting garbage data in, you get garbage data out. So we have to really try and double check this one way or another. So if people don't know how much they're spending, one way to approach this topic is, what is your take-home pay? And are you spending all of it? Are you saving some of it? And we can start there and get a reasonable estimate.
For people who are living on a fixed income, maybe it's Social Security, maybe, they got a little nest egg, just a little bit of savings, and you're living on your Social Security. When the market does fluctuate like this, and when volatility creeps in, when oil prices creep in, when gas goes up over $4 and it's $4.33 as opposed to $2.79 or whatever, that does get people's attention real quick, does it not?
I think so. And we're all understanding that we have to make sacrifices here and there. And if you're living on a fixed income and one area of expenses go up, maybe you have to trim back in another. But we're dealing more so with people in the retirement red zone, making sure that we have enough before we get to that point, right? We don't want to be on a fixed income in retirement and then have the surprises hit. We want to take care of all this. Think of all the surprises in advance.
Maybe there's people listening to this right now that haven't done it the right way, that didn't plan, that are kind of flying by the seat of their pants. They wake up, they're going to work, they're 55, 56 years old, and they say, oh, crap. I did not plan, or something happened in my life where I just went down a wrong financial path. What about those people? I feel like those people are left behind in so many different instances as it relates to these conversations of retirement. Can I retire? Am I going to be working until I'm 80? How will you fill that 40 hours a week? Things like that. What would you say to that guy or gal that is listening right now in the car?
Yeah, I would say, the best time to get your financial plan together was 20 years ago.
Yeah.
The second best time is today. Right? So don't delay any longer. I think there's still things you can do. You need to have a plan. You need to know, what are my goals need to be? What do I need to start saving? Where should I save it to? What is a realistic, expectation for how many years I'm going to have to work? So, and then factoring in the other things like what's Social Security going to look like. There's a lot of variables to retirement planning, but I think when people have an understanding of where they stand relative to their goals, it allows them to more easily make some decisions, maybe sacrifice, make some sacrifices today that would help set them up for a more promising future.
And to elaborate, I think with the spirit of your question, a lot of people can be bailed out with bad decisions early on by delaying Social Security to age 70. Mm-hmm. And having a reasonable lifestyle, not having a mortgage in retirement, working a little bit longer than, average. And then, I don't want to be morbid, right? But if you do work till 70, your retirement will be shorter.
That's
right?
No, but that's appropriate, suggestions, because that's real life stuff. Not everybody can retire at 62 or 65 or 67, and especially if you just started planning when you were 55. When you start to look at your retirement at 55 or however old whatever age you are. If you did not plan 20 years ago, you've got to start today. And if you take a look at your financial picture, maybe that is something you can start working towards a goal. Okay, I've got to work till I'm 70. So for the next 15 years, for the next 14 years, this is what I can do to get there.
That's right. And now for the people that are in good shape, that can pull the trigger at 55 or 58, I'm thinking about like a Ford engineer, right?
Let's go.
Yeah, so they have good benefits. They have great Social Security, great pension. They have medical from 58 to 65. These people are in a great position. They've had a great match all along the way. And now we can talk about tax planning and tax optimizing, where you can get money out of that IRA into a Roth IRA. You can live on the brokerage account. You can qualify for Obamacare subsidies if Ford wasn't helping out. There's many things you can do if you planned ahead from that window 55 to 65.
Let's do that next. Before we move on, though, one of the questions, Jim, that you ask is, how are you going to replace 40 hours of your week? How much of your job is financial advisors and how much is shrink?
Yeah, I would say that actually comes up quite a bit, whether it's that retirement counseling part or whether it's like the segment earlier where we talk about market fears, the volatility, things like that. There's definitely
the psychological aspect.
To be able to communicate.
Yeah.
And marriage counseling with Is My Spouse on Board.
Marriage counseling, therapy, all kinds of stuff. We've got MDs for everything, our PhDs, whatever they call it in the medical profession. We're going to take a break, come right back with Nick Hopwood and Jim Pilat, our good friends at Peak Wealth Management in Plymouth. Don't forget, if you contact Nick at peakwm.com, Nick at peakwm.com. First 5 listeners that put WJR in the subject line, you're going to get a complimentary beneficiary IRA analysis. Don't go anywhere. It is No Lazy Money, and this is 760 WJR. We're talking tax planning next. If you missed any part of the live broadcast, we have the entire show posted, or will have the entire show posted on YouTube. Just search Peak Wealth Management or type directly into youtube.com/Peak Wealth MGMT. The entire show will be up on the Peak Wealth Management YouTube page if you missed any part of this show. And you don't want to do that because we're trying to help you all out there and help ourselves along the way. I take this advice seriously. It's like free advice for me. But gentlemen, let me ask you about this. I heard a saying a long time ago, it's not what you make, it's what you can keep. And part of that is understanding tax benefits and taking advantage of laws on the books.
Yeah, and so you're absolutely right. How much can you keep? That's the name of the game. And now with the new beneficiary IRA rules, or some people call inherited IRA rules, they've changed, and it's not for the better here. So we used to be able to stretch out our beneficiary IRA withdrawals over our entire lifetime. And it was, maybe a few thousand a year kind of a deal. But the rules have changed, and now the beneficiary IRA must be completely withdrawn in 10 years after death. So if we're in our 40s, we're in our high earnings years, maybe our 50s, you inherit a big IRA like a $3 million IRA, and now you have to take that out in 10 years, and maybe it's a $300,000 withdrawal per year, pushing you from the 32% bracket into the 37% bracket, or who knows, but usually it's up another bracket, and it's painful, okay? So this is something we want to be aware of for all the people who are inheriting IRAs.
Yeah, I would say it's become a real problem. I mean, the scenario you laid out is perfect, but when people inherit this money in their prime earning years, to have to add these required withdrawals on top, or a big lump sum at the end of 10 years, it can really create some tax challenges that we want to try to navigate around.
I remember you guys telling a story a couple of weeks ago during one of our broadcasts about a guy that had to write a $50,000 check because it was a tax situation that somebody didn't catch.
Right. Yep. So this is a little different, but it rhymes. Okay. So here's the idea. If you inherit a $3 million IRA today when you're 46, okay, and you just take the required minimum out each year, okay, you're not gonna, it's not gonna be a big deal in these first 9 years. But in the 10th year, there's probably gonna be even more than $3 million in that account. It could be $5-6 million, and you have to take all of it out in the 10th year. So this is where our 37% bracket comes in, plus the state of Michigan. You're going to cut that in half, right? It's going to get hammered. Okay, so there's other strategies that we can use, and I'll use a case study in point here, where one of our clients inherited a situation like this, and they were able to have one spouse go part-time to lower their pay because they have this large inheritance, and the inheritance replaced the pay that they gave up, kept them in the tax bracket did go up a little bit each year for 10 years, but it would, in terms of the total tax owed, it was much less than if they just took it all out in the 10th year and worked for all 10 years. So this Nash equilibrium situation where I have less work and I keep more of my inheritance.
It is so complicated for me to follow all of the different changes, all of the different laws. It seems like it's a different ping pong depending upon which administration comes in and rewrites tax law. And I'm glad you guys are here to help figure that out, though, because that's why you need help. A lot of this is to understand the laws that are there that you can take advantage of.
Yeah, I would say that, and that's the point of this segment, is now that the laws have changed, there really does need to be some planning wrapped around these beneficiary IRA distributions. If you inherit an IRA, what is the best method? Do I wait till year 10, take it all? Do I spread it out? And that's where we want to dig a little deeper. And we want to start looking at what tax bracket are you in today? Which tax bracket do we think you'll be in for the next couple of years? And where do we think you'll be in 10 years? We have some clients that will inherit money. Maybe they're in their late 40s or, early 50s, thinking they're going to work until 60. Well, guess what? If you're 52 today and you got till the end of 10 years and you don't plan to work 61 and 62, You just gave us 2 years where we can now work to manage those distributions at a more favorable tax rate.
It is interesting to know that if you do a little bit of planning, then it will help you determine when you can retire a little bit. And if you want to work, feel free, but just know that this is where your tax bracket is going to go. Just know that this is money that's going to be taxable income that you're probably going to have to write a check at some point over time over.
Now, Ryan, I know you took Econ 101, 102, 401, 402. So you know these.
I did not get good grades though.
you know all about Nash equilibrium, right?
Yes.
Okay. So we want to maximize our benefits and disinherit Uncle Sam. That's kind of the approach we're taking here.
That would be great. We want to doge Uncle Sam.
Let's flip it upside down though and say, what if you are the one that has the large IRA? And you're thinking about your kids inheriting it at some point. What can you do?
Tell me.
Okay, well, let's do it. So, another case study here. We have clients who come to us. They're still working. They've got $5 million in 401s, which is a pretty big 401 balance. It means that you maxed out your entire career, okay? And you invested well.
Yeah.
Because, you can't just put $1 million in, right? You're limited with how much you can put in. So, they don't even spend much money. So, they have a great big nest egg, all pre-tax. They don't spend much. They're making great incomes, but they don't even need their income, right? They could retire today, but they love their work. So what do? You're getting heavily taxed on your salary. You like to work, so you want to keep doing it, and you're going to get heavily taxed on your IRA later. Heavily, heavily taxed. And then same thing with your kids. So Jim, what do you do?
Yeah, that's another place that planning comes into play where we need to look for opportunities to maybe do some Roth conversions, or maybe we come up with a strategy where we're going to live off of some of that IRA before we turn on Social Security. Like we need to look for, we would call them like tax valleys, where our tax rate is lower, and filling up that tax bracket, is rather than spilling over into one of the higher ones.
I think about myself as you're talking. I love my job, but if I was in a position to retire, I think I'd be out of here. I'd be gone.
Yeah, but Ryan, is your spouse on board, right?
Well, actually, the answer would be I'd still be working. I'd still be working. There's no doubt about it.
Yeah, okay, so Jim said it. It's Roth conversions. It's the key. But, if you like your work and you want to keep going, you just have to kind of accept that you're going to pay the tax.
No doubt. Ladies and gentlemen, if you have a portfolio of $1 million or more and you are frustrated with your financial advisor, perhaps because you never hear from them or have lost confidence in their work, you can connect with Nick and Jim at peakwm.com/WJR. Nick and Jim available at Peak Wealth Management. You can look for them online. peakwm.com. We are going to take a break. When we come back, talking about tax planning, talking about estates, we're going to talk about the top 5 estate planning tips and how you can reduce your estate. We'll do that next because it's such a necessary conversation to have. And if you can limit the amount of money that you give to the government based on the laws on the books, why not do that? We'll talk about it. Nick Hopwood, Jim Pilat, the president and vice president of Peak Wealth Management. This is No Lazy Money here on 760 WJR.
You're listening to No Lazy Money with Nick and Jim from Peak Wealth Management. Real people, real money, real talk. Once again, here's your host, Ryan Ermanni.
Final segment of the program here, 760 WJR. No Lazy Money. Nick Hopwood, the president and founder of Peak Wealth Management, is with us, as is the vice president of Peak Wealth Management in Plymouth, Jim Pilat. You can look for them directly online, peakwm.com. And again, if you have a portfolio of $1 million or more and are frustrated with your advisor, perhaps because you never hear from them, you've lost confidence in their work, you can connect with Nick and Jim at peakwm.com. I knew I was getting tongue-tied over you two fellas. /WJR.
You got it. Nailed it.
/WJR. Absolutely. All right, so this is a big topic, an important topic, because you talk about rules and tax planning. This is something that shifts seemingly year over year as well. We're talking about estate planning tips. Talk to me more about this.
I thought we were going to talk about Ohio State and Michigan this winter.
Oh, yeah, let's do that first.
Well, now that you bring it up, I saw a really great Twitter post, not on estate planning, but on Michigan men's hoops, women's hoops, and hockey. Turns out they're 9-0 against Ohio State this winter. Not too shabby.
Not too bad. How about that? Well, Ohio, I'm not surprised by it, actually. We're not surprised by it.
We want the Ohio State fans calling us, too. Let's,
Right. We'll compare portfolios.
Yeah, like Jordan said, Republicans buy sneakers, too.
That's right.
Yeah.
Absolutely. Ohioans have portfolios
right.
as well.
We have lovely Ohio clients, yes. Okay, so estate planning. Well, okay, we were talking about gift taxes earlier, right? So I got a question for you, Ryan. There's a $19,000 annual gift tax exclusion. Gift tax. Who pays the tax on this $19,000?
Well, the word gift, I feel like, gives it away, right? Is that...
It's a trick question.
It is a trick question, but the gift of it is that there is no tax.
Right.
Correct?
That's right. So if I gift you $19,000, I'm not paying tax on it, you're not paying tax on it, and that's it. Now, I could also gift you $20,000, and that's a little bit of a different story. So now I've gone $1,000 over the gift, and so I have to file with the IRS a Form 709 in order to track that $1,000 that I went over.
Who pays that tax?
Still no tax paid, interestingly.
Really?
But I do have a $15 million lifetime exemption, and it will erode that $15 million balance. So now, what's the math? $14,999,000 is my new estate tax lifetime exemption. So it's really no big deal.
Wow. We need to start talking to some people around here and start writing checks.
So, Jim, when do people use these 19K strategies per year?
Yeah, I think this is something that's often overlooked. I think, when we talk about estate planning, there's wills and trusts and all that kind of stuff that we can talk about. But like from a tax point of view, there is strategy behind it because this $19,000 you can give away tax free. And if you want to try to shrink the size of your estate and you want to make sure that your heirs get that money rather than Uncle Sam, this is a great way to do it because the $19,000, I could give it to, if let's say my mom was wanting to do this, she could give me $19,000. But guess what? She can also give my wife $19,000, and she can give my oldest child $19,000, and my second $19,000, and my third $19,000. Right? No tax due on any of that money. So
that's $95,000 a year.
Yeah. It's a pretty awesome strategy, and it's a pretty good way to start to reduce the size of your overall portfolio and your estate as a way to be efficiently transferring that to your heirs.
If you are in a position to do that, I heard somebody a long time ago, so somebody that was in this position, I think, back at the time, it was like a $10,000 gift or a $12,000 gift, something like that. Somebody was saying, it was something along the lines of, I want to see my family enjoy it and not wish me death.
Yeah, that's right.
It was this is why I do this. It helps me. It helps them. It helps not have to give it to the government. But it is a way that you can gift, and that's why it's said gift. It is a way to gift your family while you're alive.
It is, and so they get to, if you're the giftor, you get to witness your family benefiting from these resources. If you have a young family, it's tough, right? Especially if you're just starting out with the price of houses and mortgage rates.
First time home buyers.
Yeah.
38 years old now. Think about that.
Right.
Think about that. It is tough.
Yeah. So, this $19,000 can really help if it's especially an annual gift. It can really help with the housing situation. It can help someone get ahead for their retirement savings and investment. You hate to see them just go buy a car with it, but they could. They can do anything they want. But you could also say, hey, Ryan, I'm going to make this gift of $19,000, and here's what I want to see you do with it. You can really be involved with the decision making, although legally you can't.
Sure.
But you can say, I'm not going to do it next year if you screw this up, kind of a thing.
Right. It is interesting, and it is a great way to be able to move that money and do it the right way, I think.
Yeah, I think it's a good way to incentivize the right behavior for young people. But the other thing that we see is that people might make a larger gift and not fill out the Form 709. You have to fill it out because there's a paper trail, right? If you don't do the 709, then you can have an issue. Jim, how many times do we work with people who are smart, intelligent, they usually make good decisions, and they don't even have an estate plan at all?
Yeah, sadly, we see that often, or we see people that have an estate plan that isn't actually executed properly. So it's useless, right? It doesn't actually work properly. So I think that it's really important to make sure when you talk about estate planning, we're talking about some strategies around it, but there is a place for everybody to have, their wills, their trust, their powers of attorney in place, powers of attorney for financial and for healthcare. These are really important things to have set and to have the people who are going to help you in that situation know where to find that information and know how to access it. I think one of the biggest mistakes, just to add one more thing, one of the biggest mistakes we see is people say, I know, I have my trust. My trust is all set. Well, guess what? If you don't title your assets properly, whether they're owned by the trust or name the trust as your beneficiary, your trust is worthless. Your beneficiary is who gets your assets if you pass. So if it's not your trust, that money never goes into your trust and the trust never works.
Incredible stuff. Gentlemen, in the final minutes that we have here, is there a message you'd like to leave with the listeners this evening? Something main takeaway from today's show that you want to share with people and how they can get in touch with you?
I go back to Jim's pre-retirement checklist. The best time to hire a CFP is with at least 5 years, because if you need to make any changes, you have a little bit of a runway in order to make those changes and have them take effect. But if you're in retirement and you're looking for a second opinion, that's another specialty that we have as well. And I think basically the beneficiary IRA analysis, this is popping up more and more, and people just don't know what the rules are, and they're not taking out their RMDs, or they're doing a poor RMD strategy as it relates to tax efficiency. So I think those are the big hitters. And then, of course, Michigan basketball.
That's right.
3-0 against Ohio State this winter, yeah.
You got it. You second that, Jim?
Absolutely.
You second that?
I like it.
All right, everybody, again, we will post this show on YouTube, on Peak Wealth Management's page, youtube.com/Peak Wealth MGMT. If you miss any part of the show, want to go back, listen to more, please, we invite you to go do that. Also, you can contact Nick Hopwood. It is nick@peakwm.com. And again, first 5 listeners will get a complimentary beneficiary IRA analysis. Also, if you've got a portfolio of $1 million or more, frustrated with your advisor, we invite you to contact Nick and Jim, peakwm.com/WJR. We'll see you guys. Hopefully, spring break is upon us. Let's get some sunshine, shall we? This is No Lazy Money here on 760 WJR.